You can be the world's best stock investors, and in this video I will show you how. Wall Street is known for attracting some of the smartest investors in the world. With elite education, decades of experience, access to information most ordinary investors can only dream of. So how could someone who's never even touched a stock possibly compete with them? The answer is simpler than you might think. You don't need to be smarter than Wall Street. You just need to understand what you're investing in better than the person next to you. And that is just the beginning, because after this I will give you 4 powerful lessons from one of the greatest investors of all time, Peter Lynch, that could completely change the way you approach the stock market. So, let's get started, shall we? What if you could find great investments without working on Wall Street? No finance degree, no expensive research terminal, no team of analysts. According to legendary investor Peter Lynch, you might already have an advantage over professional investors, and that advantage is surprisingly simple. You live in the real world. You see which restaurants are packed. You notice which products suddenly become popular. You see which brands everyone is talking about. While Wall Street analysts are studying spreadsheets, you might notice a successful business simply by being its customer. But Lynch wasn't saying you should buy every company you like. Quite the opposite. In his famous book, One Up on Wall Street, he explains how ordinary investors can turn everyday observations into investment ideas and then investigate those ideas like professionals. So today, we're breaking down 4 of the most important lessons from the book, and by the end, you may start looking at businesses around you in a completely different way. Let's begin. Your everyday life can give you an investing advantage. Imagine you walk into a restaurant you've never seen before. It's packed. You come back a month later, still packed. Then you notice another location has opened, and then another. Most people would simply think, this business is doing really well. Peter Lynch will think, who owns it? This is the idea behind Lynch's famous philosophy of investing in what you know. But there is an important distinction. He wasn't saying, I love this product, so I'll buy the stock. That's not investing. Your everyday experience is simply the starting point. If you notice a company becoming increasingly popular, investigate it. How fast are sales growing? Are profits growing too? How much debt does it have? Does it have a competitive advantage? How large is its potential market? And most importantly, how much am I paying for it? Because knowing a company as a customer doesn't mean you understand it as an investment. You might love a company's product while the stock is massively overpriced. So think of your everyday life as a radar system. It can help you discover interesting businesses before they become obvious to everyone else. Maybe you notice a new clothing brand suddenly appearing everywhere. Maybe everyone you know starts using the same app. Maybe a particular store is constantly crowded while its competitors are empty. Those observations don't tell you what to buy, but they can tell you where to start looking. And after you spot the opportunity, you have to do the homework. Because an interesting company is only an investment opportunity if the underlying business and valuation make sense. And that brings us to the next lesson. Look for companies with room to grow. Peter Lynch wasn't only interested in companies that were already successful. He wanted to know how much bigger can this company become. Imagine one company has 5,000 stores across the country. Another has only 50, but every location is extremely successful. Which company has more room to expand? The answer isn't automatically the smaller company. But Lynch would certainly investigate it. Why? Because growth creates value. A small company with a successful business model may have years of expansion ahead of it. Maybe it can open hundreds of new stores. Maybe it can enter new countries. Maybe it can introduce its products to millions of new customers. That's a much bigger opportunity than a business that has already conquered most of its market. But Lynch makes another important point. Not all growth is good growth. A company can increase sales while destroying shareholder value. Imagine revenue grows 30%, but debt explodes, profit margins collapse, and the company constantly issues new shares just to keep expanding. That's not necessarily a great business. So don't simply ask, is this company growing? Ask, why is it growing, and how long can that growth continue? Look at the market opportunity. Look at profitability. Look at debt. Look at cash flow. and look at what makes the company difficult to compete with. Because the most exciting companies aren't necessarily the ones growing quickly today, they're the ones that have a reason to keep growing tomorrow. And that's where patience becomes important. A company doesn't need to double its profits next quarter to be a great investment. If it can steadily grow for many years, the results can become powerful through compounding. But there's another mistake investors make when searching for these companies. They spend too much time trying to predict the entire economy. Lynch had a different approach. Stop trying to predict the economy. Interest rates, inflation, recessions, unemployment, market crashes. Investors spend enormous amount of time trying to predict what happens next. But here's the problem. Nobody knows the future. Peter Lynch believed investors could spend too much energy worrying about things that they can't control. Instead, focus on something much more concrete, the business itself. Ask, how does this company make money? Why do customers choose it? Are sales increasing? Are profits increasing? How much debt does it have? Who are its competitors? And what could destroy its competitive advantage? This is known as bottom-up approach. Instead of starting with, what will the economy do? You start with, what is the company actually worth? Imagine you own a business with loyal customers, rising profits, manageable debt, and strong competitive advantage. Then an economist predicts a recession. Does that automatically mean you should sell? Not necessarily. The economy matters, but a great business can survive a difficult economy, and a terrible business can fail during a booming one. That's why Lynch focused so heavily on the individual company. You don't need to predict the next recession. You need to understand what you own. Think about how much easier that is. You probably can't predict exactly what interest rates will be 2 years from now, but you can read a company's annual report. You can study its financial statements. You can understand its products, competitors, and customers. Those things are difficult enough, but they're actually within your control as an investor. And there's one final piece of the puzzle. Even if you find a fantastic company, you can still lose money. How? By paying too much. A great company can still be a terrible investment. Imagine you discover an incredible company. Customers love it. Revenue is growing. Profits are rising. Debt is manageable. The future looks fantastic. You buy the stock. And then it falls 40%. Oh, we're wrong? Maybe nothing was wrong with the company. Maybe you simply paid too much. This is one of the most important lessons in Lynch's philosophy. A great business does not automatically make a great investment. The price matters. Suppose you estimate that a company is worth $100 per share. If you can buy it for $60, that might be attractive. But if investors become obsessed with the company and push the stock to $250, the situation is completely different. The business hasn't changed, the price has. And this is why valuation is so important. One simple valuation measure is the price to earnings ratio, or PE. If a company earns $5 per share and trades at $50, its PE is 10. If it trades at $150, its PE is 30. The second company might still be fantastic, but you're paying much more for the same dollar of earnings. And when expectations become extremely high, even good results can disappoint investors. Imagine the market expects a company to grow earnings by 30%. It grows by 20%. That's still excellent growth, but the stock could fall because investors expected even more. This is why Lynch also emphasized understanding the story behind a stock. Why did you buy it? Maybe you believe the company can double its stores. Maybe you think a new product will dramatically increase profits. Maybe you expect it to expand into a massive new market. Whatever the story is, you need to watch it. If the story stops being true, you need to reconsider your investment. Don't fall in love with a stock. Fall in love with the reason you bought it. And don't confuse a falling stock price with an automatic bargain. A stock can fall 50% and still be overpriced if the business hasn't deteriorated. The important question isn't how much has the stock fallen, it's has the value of the business changed? Because ultimately you're not buying a ticker symbol, you're buying a piece of a business. And that's the heart of Peter Lynch's One Up on Wall Street. You don't need to predict the stock market. You don't need to know what the economy will do next year. And you don't need to be a Wall Street insider. Instead, start with what you already know. Pay attention to businesses around you. Use your everyday experiences to discover interesting companies. Then investigate them. Look for businesses with room to grow. Understand why they're growing and whether their growth can continue. Focus on the company instead of trying to predict every move of the economy. And above all, remember that price matters. Because even the world's greatest company can be a terrible investment if you pay an unreasonable price for it. The next great investment might not be hidden in some complicated financial report. It could be the restaurants you eat at, the app you use, the store you visit, or the product sitting right in front of you. The opportunity may already be there. The real question is, will you recognize it? And that is how an ordinary investor can get one up on Wall Street. Thank you for watching. If you enjoyed this video and want to learn more timeless lessons from the world's greatest investing and business books, consider subscribing. Until the next time, invest wisely, stay patient, and never stop learning.